Okay. Carter estimated the remaining useful life of the patent to be 10 years. The patent was carried on Ford's accounting records at a net book value of $2 million when Ford sold it to Carter. We don't care. We care what we paid for it. And we paid $2 million. Doesn't matter what it was on the books. It didn't even have to be on the other company's books. Next paragraph. During 2017, a franchise was purchased from Polo Company for $480,000. In addition, 5% of revenue from the franchise must be paid to Polo. Revenue from the franchise in 2017 was $2.5 million. Carter estimates the useful life of the franchise to be 10 years and takes a full year's amortization in the year of purchase. So it doesn't matter at what point in the year we bought it. So I'm just going to go ahead and say 1 of 17. Because we're going to take a full year's worth of depreciation or amortization anyway. Then the next paragraph says Carter incurred R&D cost in 17 as follows: materials and equipment $142,000, personnel $189,000, and indirect costs $102,000. Carter estimates these costs will be recouped by December 31 of 2020. The materials and equipment have no alternative uses. So that means they should be expensed when incurred. On January 1 of 17, because of recent events in the field, Carter estimates that the remaining life of the patent purchased on January 1 of 16 is only 5 years from January 1 of 17. So it starts out as 10 years and then it moves to 5 years. The instructions read: A, prepare a schedule showing the intangibles section of Carter's balance sheet at December 31 of 17. Show supporting computations in good form. Okay? So for 16, this would be $200,000 of amortization expense in 16, right? So that then gives us $1,800,000 as of 1/1 of 17. And remember, now it changes to a 5-year useful life. So take $1,008,000 divided by 5, 360,000. So that is amortization expense for 17, and so then this will be $1,440,000 as of 12/31 of 17. How are we doing? Are you with me? Everybody's good with the patent? Okay? Then let's talk about the franchise. Well, if it's for 10 years, $480,000 divided by 10 years, that'll be $48,000 is your amortization expense for 17. And then your 12/31/17 balance sheet should be $432. Questions? If I gave you this on an exam, something like this, and you gave me that labeled appropriately, I mean, you get the credit. what would show up on the balance sheet? The 1,440,000 and the 432,000 on December 31st of 17, which is what they're asking for. B says, prepare a schedule showing the income statement effects related to expenses for the year ended December 31 of 17 as a result of the facts shown above. Show supporting computations in good form. Okay? So, income statement effects. Under expenses, what will we show? Okay, we're going to show the amortization expense of both 360 and the 408. Okay? Then we have to pay our franchise fee expense. Remember, it says we have to pay 5% of sales, and sales were 2,500,000, so that'll be 125,000. And then we also have R&D expense for the year, which is 433,000.
For the R&D expense, you wouldn't break it down into each category, it just all be.
Just R&D. Mr. McCall, you raising your hand?
No, sir.
Okay. Questions? That was easy. That was not on my CPA exam. Boy, do I wish it would have been. All right. Questions? So you did exercise 9. You didn't have any issues with it?
You know, honestly, it would probably help if you worked exercise 9.
No. Let's go to exercise 11. Why don't I take up exercise 9 as a pop quiz?
All right.
Did you do it?
Yeah,
Oh, well then why do you want me to do it?
because it was hard.
Oh, it was hard. Oh. It's in an upper level accounting class. It was hard.
I'm just asking a question that everyone else wanted me to ask.
Oh, they asked you before.
I'm sure some people would probably want to see it worked.
Well, there's a big difference between everyone and some.
Yeah.
Big difference.
All right, well, there's a few right here.
All right, if there is time, I will come back and look at that one a little later. All right, let's look at exercise 11 on page 642. Write this down on your page where you're writing exercise 12-11. I want you to write down the following. Goodwill equals, or equal sign. The cost paid in a business combination that exceeds the fair value of the net assets acquired. the excess of cost over what? Fair value of net assets. Okay, what are net assets? Huh?
Assets minus liability.
There you go. That's net assets. It's assets minus liabilities. So you take all the assets that you're getting in the acquisition, subtract all of the liabilities that you are assuming you're going to take over, and that difference is the fair value of the net assets. Net assets is another way of saying equity, right? In the accounting equation, if assets equal liabilities plus equity, then assets minus liabilities equals equity. So this is also another way of saying net assets. And that's a term we will use repeatedly in 416, so you need to get used to it. Okay? So, look at exercise 11. It says, Fred Moss, the owner of Moss Interiors, is negotiating for the purchase of Zeifel Galleries. The following balance sheet of Zeifel is given in an abbreviated form as follows. Cash, land, buildings, equipment, copyrights, accounts payable, long-term notes payable, common stock, and retained earnings. Moss and Zeifel, now that's the balance sheet. So those things are reported at what values? What are those
Book
values
value.
that you see?
Book value?
Book values. All right? All those things you see on that balance sheet are reported at their book value. But then it says Moss and Zeifel agree to the following. Land is undervalued by $30,000. So go up to land where it says 70, mark that out, and what are you going to make it? 100. But then equipment is overvalued by $5,000. So find equipment at 175, mark through that, and what you going to put? 170. Zeifel agrees to sell the gallery to Moss for $350,000. Okay? So the cost is $350,000. So we got to figure out what are the net assets. Okay? So they want us to prepare the journal entry to record this. So here I go. I have cash that I'm getting for how much? 100? Okay, I'm going to abbreviate. I'm not going to put all the zeros. What's the next account?
Land.
What? And that's 100. Next.
Building.
What is that one?
200.
Next.
Equipment.
170.
Okay. What? That's it?
Copyrights.
Copyrights.
30,000.
Any other assets? Okay, so now skip a line. And we must be assuming those accounts payable, because it doesn't tell us we're not. Accounts payable of 50. Notes payable, 300. And then we're also, remember, we're agreeing to pay, was it 350 or 300,000? 350? Okay. So C, does this journal entry balance? 100, 200, 400, 470, 500 equals 650, 700. 470, 500 equals 700. I mean, so they don't equal, right?
But I think it's 600.
It's
Isn't it?
600.
It's 600 for the assets.
Yeah.
Four.
600,000
Yes,
You'll
600.
see it, I'll say you'll see it.
So you still need a
$100,000.
100,000 what though? Debit.
Debit, yeah.
Negative and debit.
So what is that?
Well, I know.
No, it's not.
Here are the fair value of the assets. 200, 400, you said 600. Okay? Subtract the 350. That's 250, right? So the fair value of the net assets that you're getting is 250. How much are you paying? 350. Therefore, there is some goodwill of $100,000. It is a plug figure. It's a plug. Now, it gets a little more involved when we get to 416, but that's an introduction, and we have another one here, exercise 12. Look at exercise 12. On July 1 of 17, Brigham Corporation purchased Young Company by paying $250,000 in cash and issuing a $100,000 note payable to Steve Young. At July 1 of 17, the balance sheet of Young Company was as follows. We have cash, accounts receivable, inventory, land, buildings, and equipment, and then we have accounts payable. The recorded amounts all approximate current values except for land. So up above, where you see land on the books at 40, mark that out and make it 60. Inventory, instead of 100, mark that out and make it 125. And trademarks, I don't even see trade. There they are. 10, mark that out and make them 15. Are you with me? Okay. A says, prepare the July 1 entry for Brigham Corporation to record this purchase. Okay, so do just what we just did. Do it with these new numbers. Now remember, you're paying $250 in cash and you're issuing a $100,000 note payable. Go. Okay, Ms. Toomey, give me your journal entry. Debit,
Goodwill.
okay, you're gonna start with goodwill.
What are you talking about? Are you doing the whole thing? Oh, the whole thing. Cash. I don't
Thank-
know what you. I don't
Thank
know.
you. Debit cash, 50,000. Next,
Accounts receivable, 90.
accounts receivable, 90,000.
Inventory.
Debit, inventory, 125.
Land, 70, or land 60.
Land, 60.
Building 75. Equipment 70. Trademarks 15.
Skip a line for the moment. What are you gonna do now?
Cash 250.
Credit cash, 250.
Notes payable 100.
Credit notes payable, 100.
Accounts payable 200.
Credit accounts payable, 200.
And stock worth agreed for 250.
And now it doesn't balance, does it? How much goodwill do you need? Mentally, I got 75,000, I think.
That's 65.
Okay, well, maybe I'm wrong. 50 and 90 is 140, and that 60 gives me 200, 325, 400, 470, 485.
That's right.
All right. Then, minus the 200, minus the 250, and minus the 100?
What?
So that's 550 versus that. I say it's 50 and 50 is, yeah, 65,000. So the goodwill is 65,000. Questions? Did you do exercise 13? Huh? Did you have any questions about it?
Not to ask.
There was no expense in 17 for amortization, right? I didn't have an entry.
You mean there was no impairment in
Well,
7?
no, impairment I got, but it was just, you pull with any 1231 amortization? No, that's what
Okay. All right, let's look at this. Because this is a good one. What is the carrying value of the copyrights when the problem begins? 4,300,000? All right, so that's the carrying value. The expected future net cash flows are only 4 million. So the impairment test is this. Recoverability test. Future cash flows equal 4 million. Carrying value, 4,300,000. So we failed that test, didn't we?
Yes.
So now we write it down to fair value. And they tell us in all this information that the fair value is 3,200,000. So, to get from 4.3 million to 3.2 million, that's going to be a $1.1 million impairment. So I'm guessing A, ask for,
It just said 2017.
prepare the journal entry to record the impairment of the asset at 12/31 of 17. The company does not use accumulated amortization account. So on that date, you should have debited Loss on impairment or either impairment loss, 1,100,000, and credit copyrights, 1,100,000. Okay? At December 31, they're saying the copyright has a remaining life of 10 years. And they want us in Part B to prepare the journal entry to recognize amortization expense for 2018. Debit amortization expense and credit copyrights, $320,000. $320,000. And then letter C. The fair value of the copyright at December 31 of 18. Somebody give me the carrying value. 2,880,000.
Yes, sir.
Okay, so it's on the books at 2,880,000. And then C says, the fair value of the copyright is now $3,400,000. Prepare the journal entry necessary to record this increase in fair value. What do we do?
I didn't do it,
Not crap.
Huh?
Nothing.
John.
You didn't do crap, is that what you said?
You don't make an entry because you don't impair, like, there's a loss on impairment, so you don't, like, count it up.
Okay,
It's currently held
do
in
you
use.
remember in 371, sometimes you do recover impairment losses,
Wow.
but you don't remember when?
It's available for sale inventory? No?
In an asset held for sale. But this is being used. Didn't say anything about we're trying to sell this copyright. If it were an asset held for sale and it's gone up in value, we would get to record that. But if it's an asset held for use, you do not record a recovery of an impairment loss. Since this is an asset held for use, we do not get to recover the impairment loss. Okay, let's look at exercise 17 on page 644. Do you notice how if you really learned material in earlier chapters, it would make your life a whole lot easier now? It's a shame that you like to cram and dump, isn't it? How do we fix that? Because we're dealing with that right now in our department. We're trying to address how do we fix the fact that, I had a student, and she was a good student, had me for principles 1 and 2, and then one day I filled in for the person who was teaching first intermediate one day when we were doing the allowance for doubtful accounts, percentage of sales, percentage of receivables, and blah, blah, blah. And so I was teaching that, and I asked the question, and the people just looked at me. And I knew I'd had most of them in my class. And I said, wait a minute, folks, I know good and well we covered this. And she said, no, we didn't. I said, yeah, we did. I remember we covered it. And she said, no, we didn't cover percentage. It was either, I think it was percentage of receivables. She said, we didn't cover that one. I said, well, I can show you on your exam because I put one of those on every exam into 11. She was adamant we had never covered it. And then she went home and dug out her papers and came to me the next time on campus and said, I was wrong. We did cover it. But she was hell-bent and determined we did not cover it. That's a sign, or like if we cover something in here and then 3 chapters later we refer back to it and you look at me like, Don't know what you're talking about. That's a sign of cramming and then dumping, and it never gets into your long-term memory. And so that's something that we're having to struggle with as a department. How do we address that based on the fact that this is the way students like to do? They like to put off studying until I can't tell you how many times I've had students tell me, I studied for 32 hours this weekend. Do you really think that's the way to prepare for an exam? To just not do anything for 3 weeks, and then for 2 days, take 48 hours and drink Red Bull and stay up for 3 days, and then come in here looking like some drug-crazed lunatic to take an exam? So I don't know what we're supposed to do, but I mean, we need to do something.
Maybe make the exams and principles harder so that you can't pass it if you sit there and cram all night.
Or if something's really important, maybe you ask that on several exams.
If it is a concept that's gonna keep.
Like T charts. I wish.
T
I'd been doing-
accounts.
T-
They're not charts.
I'm
They're
sorry.
accounts.
T accounts. Yeah.
Making stuff like cumulative.
Well, that's something else that we're talking about. I'm of the opinion that we need to put things that are critically important on multiple exams and make it count 10 to 15% of your grade for that exam.
It makes this class so much easier.
Because, well, you should not. What you told me the other day in my office, that you did really well in 211 and 212, and then the first time you took 371, not so well on the first exam. And that first exam is nothing but a review of principles 1 and 2. Yeah, it is. It's the accounting cycle. Preparing journal entries and income statement and balance sheet.
What are the schools who have the highest percentages of high-performing students do? How do they?
I don't know, because in accounting, we have the best students in the College of Business.
Sure.
Yeah. I mean, we put more of our students will be in Beta Gamma Sigma, which is the top honorary,
Sure.
than anybody else. So, but it's still
You
something,
talking about any other institution in the state?
no. Any other department in this building.
I got you.
Oh, yeah.
I would just be curious personally, like, okay, so you got all these, really smart kids going into college that are going into an accounting program that's a very high-performing accounting program, where those graduates are being cherry-picked by your Fortune 500 companies. And then I would say, okay, well, what are they doing? How is their program better than mine? And then I would sort of.
Because I would put
reinvent the wheel.
the best of our students, against anybody's students,
But that's the best.
but not the average, the norm. I
You
would
don't
not.
want me against them. I mean, I'm shooting straight. You don't want me against them, but I'm just saying that's what I would do. I would steal their whole process. I would.
Well, well, that's a good question.
Who is it? U.S. News and World Reports. They put out their
Yeah.
top schools and wherever. I mean, you could go
But-
look for a.
A lot of that, though, that's on Mickey Mouse crap. Like, they will say, class size. So if you got 10 people in the class versus 30 people in the class, it's a whole lot better to be the 10 people in the
Okay,
class.
I agree with that, yeah.
And I don't agree with
I
that.
don't.
But you could look at your graduate, like where are your graduates going? Like who's hiring your graduates? Versus who's hiring graduates from another program?
Now if that were used in the U.S. News and World Report rankings, I would be interested in that, but it's not.
I think one of the problems for the exams for the principles of accounting, I felt like you didn't really need to read the book to actually pass the exam, because I didn't do that for 211, 212. I just studied the homework and maybe like a little bit of the notes, and that's it. And I got A's on multiple of the exams at 211, 212. That's what I felt like.
It's not conceptual at all. Like
Yeah.
any of the tests, it's all problems.
Yeah.
Or like the multiple choice is like super easy.
I just.
The multiple choice what?
It was like easy, like the stuff that you like.
And
So there wasn't enough rigor
Yeah.
211 and 212 were not challenging enough. Okay, one at a time.
And then for the most part, I think they told us exactly what problems to.
Yeah, that's, I would just wanna slap
Yeah, when
somebody.
you got your 371, you were expecting that.
I didn't take it here, I took it at Bishop, so.
Yes, sir.
You teach 211 and 212?
I did for 15, 18 years. That's all I taught, almost.
I don't know, just personally, I feel like if I would've had you for 211 and 212.
You'd be a much smarter person today.
You would. That's how to teach.
Is that how we
Better
get
teaching the upper level courses, teaching the lower level courses, if it's feasible. I don't know.
Well, I mean, I do understand that principals,
But then again, everybody has. to-
not everybody is an accounting major.
No, they need to have an accounting
But-
major class and then a regular class for business.
But then there's a lot of people who, once they take it, they're like, oh, I like this. And they didn't know they were gonna be an accounting major to begin with, and then they get in here and they're like, oh, I like
Does
this.
biology, does biology still have a
So-
biology for non-majors and a biology for
Yeah.
majors?
I don't know. Well, that's what she just said, accounting principles for majors and non-majors, but the issue is, when I took my first principal, I didn't know I wanted to go into accounting.
Yeah.
And I got in there and I'm like, hey, I like this.
Sure.
You know, maybe this works for me. So let me keep doing it. But I had a really hard, challenging principals instructor.
Sure.
To me, like probably the best solution to get to better reinforce the conceptual side of it is to have like spread throughout the semester just quizzes that are specifically focused on the conceptual part. Because it's something like it's consistently something you have to look at, so it doesn't empty from your mind after the exam.
Well, what we've talked about is taking what I did in 371, when I taught it, I had a list of Prescott's Gotta Knows. You cannot, I mean, if you don't know these things that are on this Prescott's list of Gotta Knows, it's gonna cost you on every exam. And I brought this up to some faculty in the spring, and a person said, oh, well, I've got a question like that on my exam, but it's a bonus question. I'm like, no, this is not. I mean, I go back to, if you go to a doctor or a lawyer or something and you're one, I mean, we are a profession, folks. You go to a doctor and you say, I'm really having trouble with my shoulder, and he says, well, take your pants off, let me look at your knee. You're gonna get up and walk out. But what if that doctor said, well, I just crammed for that last night, that exam. You don't expect me to remember what a shoulder is, do you? I mean, but that's what y'all do.
Well, to the point of that, the CPA is the most trusted advisor of all of people of high net worth. That CPA is their most trusted advisor over their financial advisor, over their attorney, over their doctor. The CPA is the people that most high net worth people trust the most.
Yep. And the CPA pass rate is the lowest pass rate of any professional licensing exam in the country.
You Google what the hardest
Actuaries?
exam is.
Lower than actuary?
Hmm?
Lower than actuary tests?
I don't know if that's licensing, I don't know, but I know it's lower than the bar exam, it's lower than the medical boards.
Series 7.
So, but it frustrates me that you could tell me what you told me in my office about doing so well in 211 and 212, and then get to 371, the first exam, not leases and pensions, the first exam, which it basically is a rehashing of principles 1 and 2, and fail it miserably,
That's what I did.
so that you say, I gotta get out of here and try this
But with that
again.
being said, also, I'm not going to tell you who I had for 371, but I was a lot more attentive in 211 and 212 than I was in 371 as well. You know, when your head's on the desk asleep every single day in class, it's a little bit difficult to pass the first exam.
Well,
You
you-
slept through 371.
I thought it'd be like 212.
It's the way the questions are asked too.
Huh?
So I think it's the way the questions were asked too. We weren't told you could line hook with that one.
What, the way the questions are asked?
Word
Well,
is.
you hear me? It's just, I probably would have helped.
Glenn would.
Yeah, line hook a lot. Yeah.
Well, but I can't tell him to use
Why
Glime.
wouldn't you tell him that?
All I can do, well, what you can do is stop by his office one day and say, hey, I'm in 372 now, and we're using the Glime book, and it really helps me to understand the material.
It's free for all now.
I can't, you don't care about anybody else. You don't want anybody else to ever be an accounting major. See, he doesn't want
That's the
competition.
situation I was in. I was throwing a free for all.
Yes. Hurry.
Okay, never mind, I'm not gonna say it, never mind.
But I have encouraged other faculty to use Glime. There's Glime in cost accounting. There's Glime in income taxation, both individual and partnership and corporation. And I have encouraged the faculty, but I can't make them do it. Yeah, she uses it in 381. She's one who will listen to me, but not everybody else will. And the fact that that book, that $30 book, can be used in 371, 372, 416, and 461. All 4 classes you got to take. Spread that $30 over 4 classes, and now it's not a big deal. I mean, now it's not. I mean, I know this book is expensive, but I think for the incremental knowledge, how much it helps you figure out, do I really understand this material as well as I think I do, is important. And look, the reason I did that is because I started figuring out that students are all about how to do the problems. Everybody thinks this is a math class. It's not math. I mean, there are numbers in it, but this is not a math class. And they're not interested in the why. They want to do the how. Let me know how to work the problem. Of course, and then you want me to tell you which problem is going to be on the exam. But the how, people don't seem to be nearly as interested in the logic behind it and the concepts and stuff. And that's why, I mean, from grading my exams when I was teaching principals all the time, more people lost points from multiple choice questions than they did the problems. And so I said, that's an issue because when you get to the CPA exam, it used to be that parts of the CPA exam were 100% multiple choice. Now, I don't think any one of them is 100% multiple choice, but there's still about 70 to 80% of your grade comes from multiple choice. So you have to learn to do multiple choice questions, and they're not all definitions. An asset increases on the left side, or it ain't that. It's computations in there. So I think it's important that you get used to doing them sooner rather than later. Plus, I think it's very helpful. I mean, I think you can increase your knowledge. I taught the CPA review class here for 1997 or 98 to 2014, and probably 75 or 80% of what you do to prepare for the CPA exam is multiple choice questions. I figured up I did like 3,000 multiple choice questions before I took my exam. So, and I mean, that's a big chunk of, if you can get 90% of those right, then when you go sit in the exam, it's going to be a piece of cake. So, but you can't memorize for a minute and then purge. So we're trying to get the principal's professors to develop a list of critical knowledge, stuff that you're not going to be able to get out of here if you don't know this. Like, for example, what are the 9 steps of the accounting cycle in order? And put that on the exam, say it's worth a point apiece. There's 9 points. And then take something else. Like somebody said, I know we cover bad debt expense and allowance for doubtful accounts. But then later, if I bring it up, they're like, I don't remember that. So we're talking about putting accounts on each exam and say, 1, you tell me what's the normal balance, and 2, what financial statement is it going to appear on? And if you don't know, then it's gonna cost you points every single time this comes up on an exam. Because one of the things, I mean, when I start teaching 372, the first thing I do is put the accounting equation on the board and then expand it, and then have all the debits on the left and the credits on the right. I am flabbergasted at how many people say, I've never seen that before. How do you teach principles of accounting and not show that there's a method to it? And there's only 6 types of accounts, folks. We're not talking about 432 moving parts. 6 different types of accounts. And then all the contras. But if you know the 6, then if one's a contra to one of those, and you know what that one is, then you know it's the opposite, right? It's not rocket science. This is not that hard. It is not.
Go back and look at those.
Like, for example, well, okay. I was just about to say, but look, this is what I had people do. On that exam, they debited sick pay payable when they meant compensated absences expense or salary and wages expense. They were debiting a payable. What is that doing? Reducing a payable. That's not recognizing an expense. So that's not even knowing the normal balances of accounts. And by the time you're in the 4th accounting class, you should know the normal balances of the types of accounts, right? I mean, for goodness sakes, if you don't know it by then, when are you? So if you come up with any brilliant suggestions, would you really go back to your accounting principles instructor and say you need to make this class harder? Would you have the guts to say that?
Sure, I would, but I didn't take it here. I'll go back to Bishop and tell her.
I don't know what, I don't even know what y'all can do to change like students' minds. It's not really.
Change what?
Students' minds, the fact that you have to tell them.
Yeah, making it harder will just make students cram more,
Yeah.
That's not gonna really change that,
I feel like there
especially.
needs to be more quizzes.
There's a lot of factors to it, but when I was young, so I mean, you just don't know how to really do college, and then once you get to this point, you can't cram this stuff. I can't, I don't know.
How'd you get through high school? I mean, did you do the same thing in high school, cramming?
I didn't open a book and make straight.
I dropped out.
Man, I took 372, I got 3 weeks into that joint, and I was like, oh, I gotta drop this, man, I don't even remember none of this stuff. But, I mean,
371.
I had been 15, 16,
Yeah, I
17
mean,
years
I'm
since I
20
took.
years out of it.
So I had to go and get mine switched, but I took Principles 1, and I was like, man, this is easy, I don't even know why I dropped out of those. What the hell is this?
Okay, I'm on page 644 looking at exercise 17. Moore Company incurred the following costs during the current year in connection with its R&D activities. And there's a list of several items. And the instruction says, compute the amount to be reported as R&D expense by Moore on its current year income statement. Assume equipment is purchased at the beginning of the year. Okay, so let's go through each one of these, and we're going to put either a little Y or a little N. Y for yes or N for no. Cost of equipment acquired that will have alternative future uses in R&D projects over the next 5 years. Use the straight line method.
Yes.
So we should record, instead of recording depreciation expense, we're going to take 280,000, divide by 5, and that's going to be 56,000 a year of R&D. Okay, the second thing, materials consumed in R&D projects. Should that be R&D expense?
Yeah.
Yes. Number 3, consulting fees paid to outsiders for R&D projects. They're doing R&D work for us. Then that would also be R&D. Personnel cost of persons involved in R&D projects.
No.
Yes.
Yeah.
Why would you not? If you've got a scientist or a medical doctor doing R&D studies,
I
then
was just thinking it could have been like salaries and wages expense or something, like maybe.
not when they're doing R&D activity. You treat them as R&D.
No, yeah.
Next one says indirect cost reasonably allocable to R&D projects. Yes. And then materials purchased for future R&D projects. No, it would be set up as inventory until you consume it. Okay, now, I'd like you to turn briefly back to page 629 in your book. Mr. Carr just told me, well, I didn't know that personnel costs should be expensed when incurred.
See, it's right here.
Oh, yeah, it's right there. And we went over it.
I found it.
In class. Oh, you found it. Oh, I love that. Yeah. He found it in the book. Okay, good.
I have it highlighted too.
So that cramming and dumping's not over yet, is it?
Well, we haven't had the exam yet. I haven't had.
So you haven't learned it. There you
I
go.
haven't had the cram yet. Yeah.
Okay. All right, let's look at problem 4. Now, problem 4 is going to be a little challenging, so let's see how we do. On July 31 of 17, Mexico Company paid $3 million to acquire all of the common stock of Conchita Company, which became a division of Mexico. Conchita reported the following balance sheet at the time of acquisition, page 645. Problem 4. I see current assets and non-current assets, and I see current liabilities and long-term liabilities. And we paid $3 million. So, first thing I want you to do is figure out, prepare the journal entry that should be prepared to record this acquisition just using current assets, non-current assets, current liabilities, long-term liabilities, and assume we paid $3 million in cash. Go! Quickly. There's only 5 parts to this. This shouldn't take you but a minute. Okay, you debited current assets $800,000. You debited non-current assets $2,007,000. Debit goodwill. Let's leave the amount blank for the time being. Credit current liabilities $600,000. Credit long-term liabilities $500,000. And credit cash $3 million. How much is your goodwill? $600,000. $600,000. Are you with me? So the answer to question A, compute the amount of goodwill recognized, if any, on July 31 of 17, it would be $600,000. That's your plug. Okay, now turn back to page 645 and let's look at the bottom of the page. It was determined at the date of purchase, I'm sorry. It was determined that at the date of purchase, the fair value of the identifiable net assets was $2,750,000. So now how much is the goodwill? 250. We paid 3 million, and the fair value of the identifiable net assets is 2,750,000. So the goodwill, they don't tell us what needs to change. They just tell us it's 2,750,000. So goodwill is 250,000. Over the next 6 months of operations, the newly purchased division experienced operating losses. In addition, it now appears that it will generate substantial losses for the foreseeable future. At December 31 of 17, that's the end 6 months after we bought them, 5 months after we bought them, Conchita reports the following balance sheet information. Okay, so you see 450 in current assets, non-current assets, including the 250 of goodwill, or total 2,000,004. Current liabilities 700,000, long-term liabilities 500,000. So the carrying value of the Conchita division is $1,650,000. Assets minus liabilities, $1,650,000. Then it says, it is determined that the fair value of the Conchita division is $1,850,000. Do we have an impairment? No. So B says, determine the impairment loss, if any, to be reported on December 31st of 17. Since the fair value is $1,850,000 and the carrying value is $1,650,000, there is no impairment. So write that down. Okay? Now let's keep reading. The recorded amount of Conchita's net assets, excluding goodwill, so without the $250,000, is the same as fair value, except that property, plant, and equipment has a fair value of $150,000 more than its carrying value. Okay? C, assume that the fair value of the Conchita division is $1,600,000 instead of $1,850,000. Okay, we go back. The carrying value is $1,650,000. The fair value is $1,600,000 now. Do we have impairment?
Yes.
Yes. So now what we have to do is figure out what is the fair value of the identifiable assets. We'll go up there to $2,400,000, and out to the right of the $2,400,000, I want you to subtract $250,000. We're throwing out the goodwill, and add the $150,000 increase in PP&E. So, what is the fair value of the Conchita division excluding goodwill?
$2,300,000.
Say it again?
$2,300,000.
No.
No.
No, you're not just the 2,400,000. What's the total fair value of the whole thing? Take the $1,650,000, subtract $250,000, and add $150,000. $1,550,000, isn't it?
Yeah.
Are you with me? $1,550,000.
$1,500,000.
I'm sorry. I thought he said.
No,
$250,000.
take $1,650,000, subtract $250,000, and add $150,000. And what do you get? $1,550,000. Now that's the fair value excluding goodwill. But the fair value of everything is $1,600,000. So how much must be the fair value of the goodwill? $50,000. $50,000. Okay, y'all clearly are not getting this. All right. it's $450,000 for the current assets and $2,400,000. And then what are the current liabilities?
$700,500.
So the carrying value is $1,650,000? Okay. This is the carrying value on December 31 of 17. Okay? And then in part C, they tell us that the fair value is $1,850,000. So there is no impairment. Then they turn around and say, okay, forget that. Now, the fair value of the whole thing at 12/31 of 17 is $1,600,000. Are you with me? So we've got some impairment, don't we? So now what we need to do is figure out what is the fair value of the business identifiable assets. Throw goodwill out. What is the company worth excluding goodwill?
$1,550,000.
And so what I did is I subtracted the $250,000 of goodwill to get that out, but we were also told that PP&E needs to be increased by $150,000. Now you only do this if there's impairment. If you don't have impairment, like in the first case, we don't have to go this way. So now what I said to do is take the $1,650,000, subtract $250,000, that gets you to $1,400,000, and add the $150,000 gets you $1,550,000. That's the fair value at 12/31/17 without goodwill. So if the fair value of everything is $1,600,000 and the fair value of everything excluding goodwill is $1,550,000, what is the implied value of the goodwill?
$50,000.
$50,000. So then how much of an impairment do you have?
$50,000. $200,000.
$200,000. Because right now you've got goodwill on your books at $250,000, right? But the implied value is only $50,000, so you got to record an impairment of $200,000. Isn't that part D? Prepare the journal entry to record the impairment loss, if any, and indicate where the loss will be reported on the income statement. Okay, that would be loss on impairment, debit, $200,000. Credit goodwill, $200,000. And where will that loss on impairment be reported?
Income statement.
On the income statement, where?
Other comprehensive income.
Other expenses and losses section of the income statement. Other expenses and losses. Yes, sir.
So for that, could we just take the carrying value minus the fair value, which is $50,000, and subtract that from the goodwill in A, part A, to get the $200,000?
Well, that's giving you the impairment. That's not giving you the value of the goodwill.
Yeah, but I mean, you kind of have all the numbers right there then at that
But that is the implied value of the goodwill, but that's not the impairment. But, so yes. I mean, as long as you know, that's not my impairment.
Would that work every time, like no matter
Yeah.
what? Okay. Okay.
Questions? We will do this in much more detail in 416. 416. All right, let's go back and look at exercise 9. Accounting for patents.
Oh, yes.
All right. During 2013, Winston Corporation spent $170,000 in R&D costs. As a result, a new product called the New Age Piano was patented. The patent was obtained on October 1 of 13 and had a legal life of 20 years and a useful life of 10 years. Remember, we amortize it over the lesser of those two. Legal cost of $18,000 related to the patent were incurred as of October 1 of 13. Okay, so A, prepare all journal entries required in 13 and 14 as a result of this information. Okay? So, we would take 18,000 divided by 10 years to get how much it is a year, times October, November, December, 3/12. How much is the amortization expense for 13?
$450.
$450. Okay? Then, amortization expense for 14 will be 1,800. Right? 18,000 divided by 10 is 1,800. So they're asking us to prepare journal entries. So, first thing I would do is debit patent 18,000 and credit cash 18,000. I'm sorry, that should be on 10/1 of 13. Then on 12/31 of 13, I'm going to debit amortization expense, $450, and credit patent, $450. Then on 12/31 of 14, I'm going to debit amortization expense and credit patent, $1,800. And that should do it for A.
So you don't record the R&D expenses?
Oh, yes, you could.
Okay, I did, so I'll put.
Okay, that's fine.
Okay,
Debit R&D expense and credit cash.
okay.
Okay? And so at this point, at 12/31 of 14, what do we have? It's 2250, 15,750? And then they say in letter B, on June 1 of 15, Winston spent $9,480 to successfully prosecute a patent infringement suit. As a result, the estimate of the useful life was extended to 12 years from June 1 of 15. Prepare all entries for 15 and 16. Well, probably should, let's make this a larger T account. What did I say, 15,750? Okay, so what we gotta do is record the amortization expense for January, February, March, April, and May. We gotta update the account. So if it's 150 a month, isn't it? What is 150 times 5 months? 750? So that is the amortization expense from 1/1 of 15 through 5/31 of 15. And then we would add, was it 78, 20, 80, what's it now?
9480.
Huh?
9480.
9480. So now we add the 9480. So we're at 24,480. 24,480
Yes.
as of 6/1 of 15. You with me? And now that extends our useful life to 12 years. So now what I would do is divide 24,480 by 144. 144 months.
Does it push it out 12 years or?
It says 12 years from June 1 of 15. Yes. How much? 170? Okay. So then,
I didn't get that. I got something different. Are we doing it for the last 7 months, right?
It
Yes.
pushes the useful out to 12 years, not.
that's why I said.
I came up with 1190, so.
That's what-
1190. Is that what you got too? 1190?
He was just talking about.
How'd you get 1190?
You multiply by 7 months.
Yeah. The 20.
Okay, well, he was just telling me what the monthly was. Somebody was just telling me the monthly. It was 170, right? All right, now you gotta multiply that times 7 months. 7,749, yeah, that's 1170.
1190.
1190. Okay, so again, then, first thing I gotta do, as of 5/31 of 15, I've got to record my amortization expense of $750 and credit the patent $750. Then, on 6/1 of 15, I'm going to debit my patent for the successful lawsuit of 9480 and credit cash, 9480. Then, at 12/31 of 15, I'm going to debit amortization expense and credit the patent for the 1190 for the rest of the year.
Is it okay that I did the amortization expense for, like, dated at 12/31 and 15, you just add the 750 and 1190 together?
Yeah.
If I showed you the pull over here, when.
As long as you record amortization expense of whatever that total is and credit patent for that total, you're good. Oh, and they want us to do it for 16 too. So then you're going to, for 12/31 of 16, you're going to debit amortization expense and credit the patent. What is 170 times 12?
2040.
2040? 170 times 12 for the whole year. Questions? And then in C, in 2017, Winston determined that a competitor's product would make the New Age piano obsolete and the patent worthless by December 31 of 18. Prepare all journal entries required in 17 and 18. Okay? Well, I need to post my 2040. So at 12/31 of 16, somebody help me. 24,480 minus 1190 minus 2,040.
21,250.
Say it again.
21,250.
21,250. Okay. So now they're telling you, here you sit on December 31st of 16, and you have now determined that a competitor's product is going to make your product obsolete in 2 years. So what are you going to do? You're gonna take this 21,250 and divide by 2, and that will be amortization expense dated 12/31 of 17. What's it gonna be? 10,625? So that's your amortization expense for 17. And 10,625 is your amortization expense for 18. Questions? Now that one, I think, belonged on a CPA exam, not the patent and franchise we did earlier. That was too easy. Questions? All right. Where are you going?
I go to the restroom.
Does everybody have their chapter 18 class notes with you? Mr. Jackson, would you mind going and, how many people need them?
I knew one too, Mr.
Well, why don't you print out about 20 class notes from chapter 18?
No, she'll send it back and tell you, oh, I found this. They get your Dropbox, it's like, but it's not like,
Doctors, you could do is you could require, they could require the T accounts on those tests to
No,
force
I'd be like,
all of those,
I know,
all of us
every
students
now
how to
and
use
then,
those
payday,
T
payday,
accounts.
payday, because
Like you
off the
said,
back of my
last
second broke
homework, you
shit.
notice.
When you get paid,
you
that's.
notice that a lot of people don't use the T accounts on the homework, I mean,
And a lot of people got wrong numbers on the adjusting entries on chapter 17 because they did not use T accounts.
you know,
And
somebody could, I mean, you could easily,
Yeah, like
you
that's
could,
part
you
showing.
could work it over, I mean, you know, you could work whatever you want to, I mean, we live in 2018, but if they gotta track all those entries and then show you how they're doing their work, I mean, it's easy.
yeah, I'm going to upload something Mr. Dong just asked too. The Prescott's Got a Nose from 371. And what I am going to do starting in the fall, I'm going to start putting them. When I taught 371, I started that process of putting Got a Nose. And what are they? Only 3 pages, right? I had the question and the answer, question, answer, question, answer, over 3 pages.
I think it's 2 pages, and then for accounting 2 is 1 page.
Oh, okay. All right. So it's only 2 pages for 371. But part of it was those definitions in chapter 2, I think. There were 10 definitions. I didn't put them. I just said they're on pages so-and-so and so-and-so. And I didn't want you to regurgitate the definition, but I wanted you to be able to recognize a definition. When I gave you a definition, I wanted you to tell me what it was. So I think that's what we're going to put that same, we're going to use that same approach in the principles classes, that if it's something that's critically important, and we've talked about what those things are, they will be on every exam.
You said you did.
Oh, you stapled it too?
Oh, yeah.
What a guy.
Thank you, Mr. Jackson. Mr. Carr just asked, why didn't you hole punch it for
No,
me?
I
Yeah.
was talking to myself.
He said their whole country.
All right, folks. Look on the board. Chapter 18 is on revenue recognition. It is one of the, if not the most controversial topics in all of financial accounting. In fact, the SEC issues A and AERs. That's accounting and auditing enforcement releases. In other words, when they find that somebody's doing something bad, they issue an AAER and say, here's what they were doing, and we told them to stop. Let me give you an example. Let's suppose you and I, or not you and I. Let's suppose you decided that you wanted some furniture. And you leave here today and you go to Haverty's. I'm gonna beat the two of you.
Oh, we're
Just
talking
her.
about this.
Just
I know, well.
You go to Haverty's and you're looking for furniture and you walk around the corner and all of a sudden there it is. There's the living room suite of your dreams. Sofa, love seat, recliner, coffee table, end tables, lamp, everything. Just like what you were hoping to find. And let's say that it costs $4,000. And you say, how soon can you deliver? Because I really need this. They say we can deliver on July 11th. Because, July 4th is coming up. They've got lots of scheduled deliveries before you. And so they can't get to you until, I just picked a week after July 11th. So Wednesday the 11th. Okay? You fill out a credit application, and they take that in the back and they fax it to a couple of finance companies, and one finance company comes back and says, we will lend this person the money. So this person is approved. And they come out and say, congratulations, we got you approved. And the first payment will be 30 days after the furniture is delivered. And you'll get a coupon book and all that kind of stuff. Okay? So you're real happy. You get ready to leave. You walk out of the building. My question to you is, as the accountant for Haverty's, what do you do today? Date it 6/28 of 18.
Book your sale.
Book the sale.
Okay. You got a finance company paying you 100%. Customer's paying them.
What do you think, Mr. Bland?
Depends on the delivery terms, right?
You don't think anything. What do you think, Mr. Jackson? If some of you are thinking about you want to go to graduate school, because you may finish school with 120 hours or so and you need 150 to sit for the exam. When you go to graduate school, that's what a lot of graduate school is. Okay, now we're going to, you learn the nuts and bolts of calculating depreciation and all this kind of stuff in the undergraduate program. In the graduate program, you start talking about, why do we do it that way? Is that the right way? Is there a better way? Could we do it differently? And so you would take a position, and then somebody else is going to critique your position. Either I agree that that's the right position to take, or no, I think this is why I don't think that's the right position. So Mr. McCall has said, book the revenue because you have a finance company that has approved the customer to lend the customer the money. And so he says a sale has happened, it's time to book a sale. I'm asking Mr. Jackson, do you agree, yes or no? And if you agree, why? And if you disagree, why?
Honestly, I would agree for the same reason, but the only other way would be to open up like a table. But
paying them, so I guess that's not correct.
What do you say, Miss Finch?
I would book it that day,
You would book it that day.
yeah, and put it as a receivable.
Anybody else? Okay, you could all work at Haverty's because that's what they were doing. And the SEC came in and said, no, 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 no. Because what if that furniture store burned down tonight with your furniture in it? Do you own that furniture?
Yeah. I don't know how the Haverty's does.
Well, then how did they sell it to you? You just said record the sale.
Same thing.
Well, you didn't disagree.
He got you as a co-signer.
You were waiting. Has an exchange taken place?
No.
Not until the furniture is delivered. Now I owe you. This is what Haverty's was doing in all their stores. They were booking the sale when they took an approved credit app. Now think about that. If you got 30 stores or 50 stores, and each, the average sale is $4,000, $5,000, $6,000, $7,000, and you're booking it on March the 31st, and you're not going to deliver it until April the 16th.
Well, too, you gotta think, I bet they were playing dates, because if you don't have an actual sale, you could book it on the 30 or 31st end of the month, or you could even push it forward into the second, depending on how you need it.
Well, until there's an exchange, until you deliver, then a sale hadn't happened. I mean, say you go into the mall and you find some clothes that you want, and you say, I didn't bring my money, or I lost my wallet's at home, I gotta go back and get it. But keep all these clothes right here. Has the sale happened? No. So, now that is a very simple example. Go into the mall, point of sale. It's pretty easy to figure out when the sale ought to be recorded. When you pick up clothes and you say, I'm willing to pay these prices, and you take it to the cashier and you say, here is my money, or here is my credit card, here's my promise to pay you, and they say, okay, there's a meeting of the minds, and you walk out with your stuff. What are you going to say, Miss Walker?
No, I was just gonna ask, when the previous one about when would the finance company actually give you the money whenever the next day? After?
Once Haverty's tells them they have delivered the furniture, then they will ship them the money.
Okay.
Because until there's an exchange, the transaction hasn't happened. Suppose that furniture is discontinued and it just burned down. Do you still owe them? They can't get that furniture anymore. I mean, it's a discontinued line. It's over. I mean, you can't get any of that furniture, so no sale took place.
Yeah, I had a nightstand not fit, so I was like, don't want it, so that ended up coming off, and then they financed only what I kept.
Mhm.
So if they would've recorded it, oh, she got all this stuff, I didn't really get all this stuff.
So,
What do they do to-
all right, let me give you another one. You can deal with this. When should the university book tuition revenue?
After the drop date?
Yeah.
Okay. Really? If you drop today, do you get any money back?
Well, after the date that you can get your money back, right?
Well, then that's not the last day to drop.
Oh, well, I don't
The
know.
last day to drop is next week, or is it the 4th or 5th or 5th of July?
But don't we have a date that you can?
But there is a date after which you cannot get a refund.
Yeah.
So is that what you meant? After the refund date expires, or the refund period
After you're
expires?
stuck, after your money's there, stuck in that class.
Because now I get to keep your money now,
Yeah.
Yes.
right? And I don't know what the university's policy is. It could be that we record it as of the first day, and then whatever refunds that people transfer out, the refunds are considered immaterial, So they're not a big deal, because you probably switch from one class to another class, so you're still gonna pay that tuition. It's just, you don't go from 18 hours to 12 hours or 9 hours probably. Okay. Suppose the university is looking to a computer programming company. We're gonna buy some software that's similar to Paul's, but it will integrate Paul's, the registrar's office, grade reporting, everything that we have multiple programs for now on the school side. It'll do all of that. And you've been talking to the university, the salespeople have been talking to the university, convincing us that's the thing to do. And they say, tell you what we'll do, we'll sell you the software, we'll come out here and conduct X number of training sessions for you, and we will give you free customer service for 1 year from the date of installation. And then the university representative says, and how much will that cost? And they say $10 million. Okay, all right, we want that. When does the software company recognize the $10 million?
It should be amortized, shouldn't it?
I don't know. What I'm asking you.
I think it should be amortized.
Take the 10 million and amortize it over what period of time?
An estimated guess for how long they think that it's going to be useful. The administration believes that this information system will be helpful.
Okay, wait a minute.
How long it'll be used?
So you're gonna book revenue based on how long the university thinks they're gonna use the software?
No, not revenue. No, I thought you were talking about the university, the expense.
That's what I'm talking about. When should the software company recognize revenue?
Okay,
When they implement and start running the software is what I would say.
When they install the software?
Yes, when everybody's up and going on it, yeah.
After
When
that.
they're up and running on it?
Well, when their obligation, I guess, I don't know.
What's-
That's the gray area.
Do you see what it would be like to work on the FASB?
Yeah.
I mean, you gotta struggle with this kind of crap. And you've got to come up with guidance that hopefully covers lots of industries, not one industry. Because think about it, if you're doing one industry, then now you gotta go turn around and there's 15 other industries that need guidance, so now you gotta issue 15 more standards. When should an airline book revenues from flights?
The 24 hours before.
24 hours before.
Whenever you can't cancel.
Okay, now let's think about that.
The services, when the services provided.
So, all right, when the plane lands,
One plane, yeah.
all right, well, you just said 24 hours before it's taken off. We don't decide.
Well, I mean, what if the plane doesn't get to go anywhere? You don't get you don't get a refund, do you? I don't know how that works.
Wouldn't it sit as a receivable until services have been rendered by?
Well, that's what I'm asking you. When is service rendered? The minute you take off, the minute you land at your destination?
I mean, I guess that just sounds what contract you agreed to whenever you buy the
Yes, we
ticket,
board that plane,
right?
I don't know.
I mean,
As the
buying
boardings
ticket,
are
it's
coming
unearned
in.
revenue,
Well,
and then they fly.
Okay,
Yeah, whatever you want.
I would say it's once the plane takes off. Because they don't guarantee you're gonna land. And they don't tell you how you might land. I mean, remember that Singapore airline, that plane's still flying somewhere, they still haven't found that thing. I bet they booked that revenue though. Book that revenue soon, take off, we have revenue. Thank you very much. How many of you belong to Costco or Sam's Club? You buy that membership. How should that revenue be recognized?
After the 30 or no, it's you have a certain amount of time that
Look,
you,
he's
if
arguing
you
with
don't
himself. If y'all notice that, she's halfway into her answer and then she's like, even I don't agree with what I'm saying. I'm going to take that back and say this. What should they do?
Well, I forgot my train of thought.
When should Sam's Club recognize the revenue? If you pay, let's just make it something easy, $48 for a year's membership. You can go in that Sam's Club for the next 365 days anytime you want to.
Well, when they
because
make-
you've got this
Is it
card
a
now.
non-refundable fee or?
That's what I'm talking about, because some of them, if you're not satisfied with whatever you get, you can get all your money back.
I say you get rid of the revenue when you get it.
I don't think you'll get your membership back from Sam's Club.
Costco.
Or, but shouldn't it be recognized ratably over the 12 months?
Yeah, I mean, as you.
Because what if they close down in 6 months? Are you entitled to a refund?
Maybe. not.
Yes, you, look. Who would ever pay for a year in advance and then day after tomorrow you shut down and say, we get to keep your money? I mean, a few years ago, this happened. There was a gym on Moffett Road that had WABB, back when WABB existed, having they were, you know, I don't know, $50 a month, so that'd be $600 a year. But if you'll pay cash up front, $300 for a year's membership. And a lot of people going up there and doing it. Okay, they got all that money, did that for a couple of months. In the middle of the night, they pulled a semi-truck back to that building, loaded all that equipment on it, and left town.
I bet they booked all that as revenue.
And I bet they did too. And I bet the district attorney for Mobile County went after them because you owe a refund. Now, Sam's Club's membership might say there has to be one within 75 miles of you or you get a refund. So, I mean, if you're the only one and 500 miles away, they're not going to say you got to go to that one. They'll probably say it's got to be within a reasonable distance for you to be able to drive and make use of it, or they want to refund your money. Magazine subscriptions, that revenue should be recognized as a magazine is shipped to you. Okay? So, but now let's go back to the situation where the software. The problem with coming up with an approach that is applicable to an airline, a university, a grocery store, somebody in the mall, a manufacturer, a hospital. I mean, think about how difficult it is to come up with accounting standards that can be used in 50 different industries, and it can be used just the way it is. Nowhere in there is it going to say, if you pick up freight in Mobile and deliver it to Montgomery, once you drop it off in Montgomery, you can book revenue. Not going to say that. It's got to be more generic. So, more accounting and auditing enforcement releases are issued on the topic of revenue recognition than any other topic. Because there are so many different industries, so many different ways to make money, so many different business models, if you will, it's hard to develop an accounting standard that's applicable to everybody. And then even when you do, you and I should have known that Haverty's should not be booking the revenue until they deliver the furniture. Right? You don't owe them anything if they never come and deliver furniture, do you owe them anything? So an exchange hasn't happened. Once they delivered the furniture, now there has been an exchange. Okay? So that's what this chapter is about, revenue recognition. And in 2014, the FASB issued Accounting Standards Update number 2014-9, Revenue from Contracts with Customers. And before, the FASB had issued lots of stuff that was related to software developers or the airline industry or construction companies. But this one, they said, we want this to be applicable to everybody. It's going to supersede all other revenue recognition guidance we have ever issued in the past. Okay? So here, and when I first heard the title, I'm like, well, when I go to the mall, that ain't a contract. If I go to the grocery store, I don't enter into a contract to buy milk from them. But the FASB said, yeah, you do. It can be implied. When you pick up a dress or a suit and you say, I want this for this price, it looks good on me, then there's an implied contract between the two of you. If you'll pay me what price is on that, I will let you walk out of this building with it. So look at the overview of revenue recognition. Accounting Standards Update 2014-9 adopts an asset and liability approach as a basis for revenue recognition. The asset liability approach recognizes and measures revenue based on changes in assets and liabilities. Under the asset liability approach, companies account for revenue based on the asset or liability arising from contracts with customers. Companies analyze contracts with customers because contracts initiate revenue transactions. Contracts indicate the terms of the transaction, provide the measurement of the consideration, and specify promises, that should be promises, that must be met by each party to the transaction. The key objective of revenue recognition is recognize revenue to depict the transfer of goods or services to customers in an amount that reflects the consideration that the company receives or expects to receive in exchange for these goods or services. Okay, now, they specifically developed a 5-step model. The 5-step process for revenue recognition. If I were to give you a thing for things to know from second intermediate, this would be one of them, this 5-step model. Number 1, identify the contract with customers. Number 2, identify the separate performance obligations in the contract. Okay, so talking about our software deal, I look at that and I see 3 distinct things that the software company has agreed to give or provide to the university in exchange for $10 million. 1, they're going to give you the software, install the software on your mainframe computer. That's the first thing. They're going to provide some training. And they're going to give you 1 year customer service at no charge. Those are 3 separate performance obligations. And we're going to recognize revenue as we complete those performance obligations. So the step 3 says, determine the transaction price. That's the $10 million. Step 4 says, allocate the transaction price to the separate performance obligations. So, the company has got to say, okay, if we were doing nothing but installing the software on the hard drive, what would we sell this for if that's it, all we did? They say $9 million. Okay, then of the $10 million, $9 million is due upon installation. Then, how much would we charge standalone if we were coming out and doing training in any of our software? You would have to ask the university how many people are going to be in the room, because I'm going to charge you more for 5 people versus, 105 people versus 5 people, right? If you want me to do 15 sessions or you want me to do 3 sessions, so I got to know the details. And maybe they'll say, look, we'll do 8 hours of training, many people as you can get in the room. We don't care. But 8 hours of training. Okay? So that's 1 training session for 8 hours. And then the customer service, we would have to figure out what would we charge if we were going to, at the end of a year, the university says, hey, we need another year of customer service. Okay, we're willing to pay for it. How much would you charge for it? And then step 5, you recognize revenue as each performance obligation is satisfied. Thus, the revenue recognition principle now says recognize revenue in the accounting period when the performance obligation is satisfied. Now, think about this. So, performance obligation can be thought of as, what does Haverty's have to do? Deliver furniture to where you've instructed them to deliver. What does an airline have to do? Transport you from point A to point B. What does a university have to do? Hold the class that you paid the tuition for. So they came up with the idea of a performance obligation. They didn't say service, because it's not always going to be a service. It can be a tangible product. Like you go to the mall or you go to the grocery store. You're buying a product in that case. So if you think about the beauty of this standard, is they had to think in terms of, is it going to be applicable to any industry we can think of? Because that's what we're going for. We want something that's applicable to anything. And they came up with this 5-step process. I actually attended in May, I went to Dallas-Fort Worth. The Federation of Accounting, Schools of Accountancy held a 2-day seminar on revenue recognition, where they were teaching teachers about how to teach this and talk about it and discuss it with students, and auditing professors. How do you audit this new standard? Things like that. And we asked, you may not know, but the Department of Accounting does CPE seminars, continuing professional education seminars, because CPAs in public practice have to get hours every year, 40 hours a year. And we host an 8-hour CPE session once a year. And when they did the one last September, they asked, what are some topics you would like to see us cover in the future? And at the top of their list was the new revenue recognition standard. So, unfortunately, I'll be teaching that in September to a bunch of CPAs, because they're like, it's coming. It's about, for some public companies, some have already adopted, but then others or it's coming. And so that's what we're talking about. So turn the page. Turn to page 2 of the class note. So I've given you the 5-step overview, but now we're going to go into more detail in each of the 5 steps. The first step, remember, was identify the contract with customers. Here I say that in order to be a valid contract, the contract must have commercial substance. Okay. Commercial substance means it puts you in a different position than you were in before. Puts you in a different position than you were in. If you agree to pay for the Haverty's furniture if they deliver it to your house, aren't you in a different position when you walk out of the building than you were when you walked into the building? Because you have a promise to pay if they deliver. And isn't Haverty's in a different position that than they were in before you walked in the building? Yes, now they're obligated to bring you your furniture. 2, the parties to the contract must have approved the contract. And there must be a meeting of the minds. You can't go in there and say, oh, you want $350 for that suit. Okay, I love that suit. I'll give you $250. And if they don't say yes, then there's not a meeting to terms. C says you must be able to identify the rights of the parties to the contract. D, payment terms must be identified so that we can hold you responsible. And look at the next one, and please highlight the word probable. Probable that the consideration will be collected. So that's why when it's an account receivable, we still book it, even though we're not 100% guaranteed they're going to pay, right? Okay. So contract does not have to be in writing. It's got to have explicit terms that put us in a different position than we were in before we entered the contract. We got to be identify the rights and obligations of the parties. The payment terms have to be spelled out, and the collection must be probable. 2, identify the separate performance obligations in the contract. Now, Then there's an asterisk that says not every contract will have multiple performance obligations, right? I mean, you may walk in, you may be going to Joseph A. Bank this afternoon and you want a tie for something you're gonna do this weekend, and you want a tie that's gonna go with a specific suit, and that's all you're going in there for is a tie. You don't plan to buy anything else. Well, then there's not multiple performance obligations in this. It's when there are multiple performance obligations, like the software, the training, and the customer service, that it becomes more involved, because now we've got to start allocating the transaction price to these multiple performance obligations. Here, the objective is to determine, highlight, whether the nature of the seller's promise is to transfer individual goods and services to the customer, or to transfer a combined item or items for which individual goods or services are inputs. If separate performance obligations within one contract are distinct, meaning they can be sold separately, they are not interdependent. Okay, so for example, if you go to Starbucks and you say, I want whatever, and please add some cream, okay? Is that two things?
Nope.
No. I mean, because they're not going to say you what they're going to do, squirt it in your mouth. I mean, if you say, I just want the cream by itself. No. I mean, so the point here, but if you want a suit and the shirt and the tie, these are separate performance obligations. They can be sold separately, right? So that's what it's talking about. You got to be able to look at it and figure out, are these distinct products or are they one thing? The coffee with the cream is one product. We're not going to book that separately. Okay, go to part 3. Determine the transaction price. Now, this is not as easy as it may sound. There may be situations in which the contract may call for variable consideration. Okay, now listen to this. The university, is about to engage somebody to build a football stadium out there on the intramural field. Okay? And I believe I heard that Dr. Waldrop said that if we want it to be able to start by fall of 20, you got to break ground no later than July. Okay? So, maybe. Are you okay?
Thanks.
Why could she not sit in the back so she wouldn't be so distracted? So we might write a contract that says, here, the $75 million to build this thing. But if you don't finish by July 31st of 2020, there's going to be a penalty. Because if we wind up losing some or any of the fall of 20 that we can't use the stadium because it's not completed, then we're still going to have to do the LAD stadium thing, and it's going to be different costs and everything else. So you want to penalize them, or maybe you want to reward them if they get through sooner. Okay? So that's what variable consideration is. It's not just $10 million, a flat $10 million. It may be that if you do it quickly, we'll give you an extra $100,000 or $500,000. Or if you're late, we may penalize you and pay you less than $10 million. It's whatever you can agree to. And folks, when I first came here from Birmingham, we had a customer of our bank that was building, I've got to be careful, building something, and because he had signed a contract with a governmental body, he was having to work 24 hours a day. They had those big lights going so that he could work 3 shifts because he was being penalized for every day he was late. And so he was working shifts 24 hours a day to try to finish. So, because he was doing something he'd never done before, had never built this particular item before, but he bid on it and won it. Probably wishes he'd never even seen a parking deck. So, the contract may call for variable consideration. In this case, companies should use either, please highlight, expected value, which is a probability weighted amount, or the most likely amount in a range of possible outcomes to estimate the variable consideration. For example, we may sit down and talk, we may say to the guy, if you finish it by July 31st, we'll pay you $75 million. If you finish by March the 31st, we'll pay you an extra $3 million. If you finish, that kind of thing. Then what we would do is we have to sit down and determine how probable is it that one, he will finish exactly on time, July 31st. Then and that'll be between 0 and 100%. Say, we think it's 50-50. Then, how probable is it that he will be able to finish by March the 31st? Well, that I think is 10%. Well, we gotta keep going until we get to 100%. We multiply how much we have to pay in each scenario by the percentage, add that up, and that's our total. You'll see how we do it when we do some of the homework. Number 4, allocate the transaction price to the separate performance obligations. That's what we were talking about a minute ago. Take that $10 million price that the software company is charging the university and allocate. How much of that is delivery of the software? How much of that is delivery of the training? And how much of that is 1 year of free customer service? Now, it may be necessary to allocate the transaction price to multiple performance obligations. If allocation is necessary, the portion of the transaction price allocated to the various performance obligations is based on their relative fair values. Okay, listen to me. This is saying this. Suppose the $10 million that we just went through, as a bundle, I'm giving you that for $10 million. I'm giving you the software, free training, and free customer service for 1 year. But if I sold any of those standalone, and each one of them is available to be sold standalone, it totaled $12 million. You with me? So now we've got to go through and figure out how much, using the relative fair values, just like you did in the inventory chapter, just like when you bought a piece of land, equipment, and building, and you had to do it based on proportion of fair values. You allocated the cost based on proportionate fair values. Same thing is done here. And it's easy to do if you sell the products independent of each other. But if you don't, we don't ever do training if we don't install software. Well, I still got to break it down somehow and do this. So keep looking. What does it say? The best measure of fair value is what the company could sell the good or service for on a standalone basis. If you just wanted the software, what would we sell it to you for? If the standalone price is not available, please highlight not. For whatever reason, companies should use the following methods in this order to develop a best estimate of fair value. They either use the adjusted market assessment approach, which means you look at maybe some prices of similar people who are also in your industry and they're selling similar software. What would they sell that software for? Now that's market data. The next one says expected cost plus a margin. Okay, now, so then what you'd say, all right, for the training, the software company would say, well, first of all, we got to fly somebody there. We got to pay them to work that day and do the training. So those would be our costs. And then what do we typically do? We add 50%, we add 100%, we add 75% to that. And then the last one is the residual approach. The residual approach says, okay, we know what two of these three things would be. So the third one we're just going to back into. Remember, we called that the incremental approach when we were issuing bonds with detachable warrants. So you just back in, you know the values of two of them, and so the third one's gotta be whatever's left over. And then page 992 gives you an example in your textbook for how each of these is done. Then step 5, next page. Recognize revenue when each performance obligation is satisfied. Indicators that control has passed to the buyer. Now, it's going to tell you below this paragraph that we're not saying every one of these has to be met. We're saying that in general, these 5 things that are listed here, A through E, generally suggest that the performance obligation has been met. A, the seller has a right to payment for good or service. Okay, ask yourself. As of today, when you leave Haverty's, is Haverty's entitled to be paid? Not till they deliver the furniture to your house. B, the seller has transferred legal title to the goods or services. If Haverty's burns down tonight, do they say, well, sorry, that's your furniture that burned down? Nope. Title has not passed. 3, the seller has transferred physical possession of the good or service. In our example, no. D, the buyer has significant risk and rewards of ownership. Could you do something with that furniture tonight? Somebody came up and offered you $6,000 for it. Could you sell it to them tonight?
No, I don't have it.
Because you don't have it yet. No. And E, the buyer has accepted the good or service. You've gone in the store, in the mall, you picked out the milk in the grocery store or whatever, and you decided this is what you want. This is a list of indicators, not requirements. Not all of the indicators need to be present for management to conclude that control is transferred and revenue should be recognized. Management must use judgment to determine whether the factors collectively indicate that the customer has obtained control. This assessment should be focused primarily on the customer's perspective. Okay. In addition to teaching, faculty members, full-time faculty members or tenure-track faculty members also have to do research. And when I was sitting